Asymmetric investments define careers. Right. Okay, that's as simple as it is. I've had 3 in my life, asymmetric investment opportunities. This is hands down the best I've ever seen. It's not even close. The other 2, which were the best up until my, my current introduction to Bitcoin, they were good, but the asymmetry of Bitcoin is just so beautiful. Hands down, this is the best opportunity I've ever seen.
Greg Foss and James Lavish are both co-founders of Looking Glass, a platform that develops global educational content that highlights the ingenuity and potential of Bitcoin. Foss has spent more than 3 decades in the financial markets, during which he managed a successful hedge fund team during the global financial in 2008. Lavish, a renowned institutional investor and Bitcoin advocate, also has over 25 years of experience in the financial markets. In a recent episode of the What Bitcoin Did podcast, both macro gurus discussed their journey into Bitcoin, the crypto asset's asymmetric valuation, and the need for regulation to stop the activities of dishonest players like Sam Bankman-Fried. Foss explains that Bitcoin's price is down, but its value continues to grow exponentially. According to the Canadian investor and macro guru, Bitcoin is a solid insurance against many of the lapses that are becoming very apparent in the financial world. When people finally realize the asset's potential, Foss and Lavish are certain that we will see an exponential price increase. We will now take you to the masterpiece discussion between Foss, Lavish, and Peter McCormack. But before we do, please take a little time to like this video and subscribe for more exciting and enlightening crypto content. Thanks and enjoy the video.
The value of Bitcoin has actually gone up. The price of Bitcoin's gone in the other direction for various reasons, but the price has gone up. I increased it by 10% because I view that as being the positive contribution by getting rid of some of the shitcoinery that's going on within this asset class. But I've run through that number with you before, Peter. How I get to 2 million. It's pretty simple. Grade 11 math. We could run through it if you want, but the reality is I sent that out by trying to make a point that the value of Bitcoin, with all these things that have gone on, macro events within the TradFi world, micro events within the crypto ecosystem, all have led me to believe my valuation for Bitcoin is higher. And why is that? Well, because the likelihood of you needing the insurance against the system has increased, meaning with all the mistakes the LDI, the pension plans are making, you need to have insurance that there's some other asset there that's going to protect you. It's education, but also there's still a lot of levered money on Wall Street that is trading Bitcoin as a risk asset, when in fact, it's going to take a lot of education to teach the hot money, let's call it what it is, it's hot money, to understand that Bitcoin is a non-correlated asset that actually is insurance, which means it shouldn't be traded as a risk asset. It's actually the flip side. As risk increases, which it is in the world, Bitcoin becomes more valuable, not less valuable. That hasn't permeated the thinking process on Wall Street yet. Why? Well, they don't teach it to you in school. When you come out of an Ivy League school and you're working on Wall Street, perhaps some of the things you were doing to begin with is writing an algorithm to discover a correlation between Bitcoin and NASDAQ stocks. And historically, it has reacted like this, so the algorithm will program it to continue to act that way until further notice. It takes a lot to break down these bad models.
What's your time scale? Sorry.
Well, here's the key. 2.2 million in today's dollars. So I have an expression, give a target, but not a time. Well, we're measuring it in today's dollars. So if it takes 20 years to get there, what is the value of today's dollars?
Oh, you think it's worth it now?
I can give you the math that indicates to me that it should be trading there. But it's only here. I'm going to flip it on its. Well, I'm going to flip it on its ear. I'm a probabilities guy, okay? And I'm never 100% certain of my investment outlooks, but what I do try and measure is what the market says my odds are, Peter. Yep. So you take, and it made the math easy when it was $20,000 versus a $2 million price target. 20,000, and it's in today's dollars, versus 2 million. You take today's price target, you divide it, trading price, you divide it by your target, and you get a percentage of what the market says your odds are. That's a 1% chance. The market is telling me I have a 1% chance of being right. And I'm not saying I'm 100% certain I'm right, but I'm way higher than 1%, ladies and gentlemen. And that's how I've always managed risk my entire career.
Right. And for anybody who is watching this and saying, yeah, but you've got to put an interest rate on that for, to discount it, we're at negative real rates.
Okay,
so
that's
it doesn't
fair,
really
but
matter.
I also
I'm
stress
saying,
it is today's dollars. Let's not mess.
So what I'm saying is it doesn't matter because we're at negative real rates. So actually it's even better than that.
Because the interest rates are lower than inflation.
Yeah.
Correct.
Yeah. So it's even better than that.
But again, bring it down to first principles, Jeff Booth thinking. It's like going to the racetrack this year for the Kentucky Derby, and you had watched the Kentucky Derby winner train all the time. And you know what the odds were going into the Kentucky Derby of that horse winning Kentucky? 80-1. And that's where the odds closed. And if the guy who had spent his life studying horses had watched this horse train, he's like, okay, 80-1 is a long shot. And I still don't think he's a lock to win it. But man, the odds aren't 80-1. Maybe they're 25-1. So that's why you have to take opportunity of wrong odds that are laid by a racetrack or by a market. All the same thing comes down to risk management.
Yeah, and we did the same thing in arbitrage. You'd look at whether a deal was going to close and you would handicap it. And if the market said it was like a 30% or a 40% or a 50%, and you thought, God, they're either I'm missing something or they're out of whack on their price. And that's where you would take, if it's a compelling opportunity and that risk reward is so great, then
I, again, it's James's show, but I can't keep my mouth
It's
closed.
our show.
It's our show.
Hey, asymmetric investments define careers. Right. Okay, that's as simple as it is. I've had 3 in my life, asymmetric investment opportunities. This is hands down the best I've ever seen. It's not even close. The other 2, which were the best up until my, my current introduction to Bitcoin, they were good, but the asymmetry of Bitcoin is just so beautiful. Hands down, this is the best opportunity I've ever seen.
Agreed.
Yeah, I think it's
Several macro investors, even people that are not entirely sold on Bitcoin and the cryptocurrency industry, have noted that the asset's odds of success might be low, but is still a great bet because of its insane upside potential. Bitcoin might have lost more than 70% of its all-time high, but that won't matter when it hits 6 figures in the next few years. In a previous interview with Seeking Alpha, Foss said, "Bitcoin is the best asymmetric trade I have seen in my 32 years of trading. I stated that I believe every fixed income investor needs exposure to Bitcoin in order to reduce portfolio risk. I believe that Bitcoin should be considered as default insurance on a basket of sovereigns or fiats." Let's get back to the discussion as Foss and Lavish further discuss Bitcoin and crypto regulation.
But this is how you line it up. And mine came out of the second one came out of the great financial crisis. And, the asymmetry was just crazy. And there was so much of this available. I was able to buy $7 billion of something for our fund that's why I hung up my cap at the end of the great financial crisis and, 4 years later, because I said, I'll never be able to recreate that opportunity. Yeah. And guess what? In 2016, I found Bitcoin, but I wasn't managing money professionally anymore, except for my own account. And that's why I've gone in with both feet. So lucky to meet a guy that speaks the same language as I do. Because that's all it is. Managing risk is managing probabilities. It's managing an expected value outcome. And that's what I take such exception with these knuckleheads on Wall Street who say, it's got no value. Okay, are you 100% certain of that? And they'll say no. And I'll say, then shut the F up because you have to play probability distributions. That's where you're dealing with the fiat mindset versus the reality of managing risk.
And really the challenge is to get some of these institutional investors to leg into the trade, get some, so it forces you to do the work and forces you to do the real research on it. And then they'll be orange pilled if they really, truly do.
What about your old buddies on Wall Street? Have you talked to them much about this?
A few, and I've got 1 or 2 that understand it. Like literally a handful.
They already did, or you've spent some time with them?
No, they already did. But beyond that, I mean, they're just, they group it up with Ethereum and Web3 protocols. And they're like, they just don't understand how it's different. They think it's all crypto and I'm just getting a little bit of each. And we're trying to, they don't understand it and they haven't done the work on it. They're mentally lazy.
Intellectually lazy.
It's intellectually lazy. And It's incredible. And there's going to be a lot of them that miss the boat, just absolutely miss the boat.
Can I add? So the cool thing is the one guy that was one of my biggest counterparty traders in this first, coming out of the great financial crisis, he was a JP Morgan trader. He just messaged me yesterday on LinkedIn because he's been following it. He does not want Bitcoin to succeed, but his spider senses are indicating.
Kicking in?
Well, he's like, hey, Foss, let's talk more about this. And I'm like, fine. I'll go into anybody's barn and have a discussion, whether they're crypto, whether they're fiat based, because it's an education process. And there's a lot of people that are paid not to want it to succeed. Okay. But there's enough smart Wall Streeters who know they have to cover their ass as well from a risk management perspective.
Like there are 5 institutions that control $30 trillion of assets in this world. You've got Fidelity, Vanguard, BlackRock, State Street, and UBS that control $30 trillion. So when they get in and they actually put it in their portfolios, it becomes a no-brainer for other asset managers to do it as well. I mean, that leads them to do it. But again, going back to our original point, which was we need some regulation in here to get them comfort to understand how Bitcoin is different, because the regulators are going to tell them Bitcoin is different, and they'll go, oh, okay, and it'll click finally, and they'll say the career risk has been, it's been taken down, and so I can now leg in, and they get in a 1, 2, 3% position. What's the math on that, right?
It adds up quickly.
It adds up quickly.
Yeah.
Though the crypto market is in the thick of a nasty bear market, there are already clear signs that recovery is going to be phenomenal. As Greg Foss notes in a recent tweet, overthinking is a fiat disease. Bitcoin has 100 times upside, yet the fiat clowns will focus on the 1x downside. Break free from the fiat Ponzi and fiat mindset. What are your thoughts on Greg Foss and James Lavish's discussion? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more exciting crypto-related videos. Thanks for watching.